Hello, welcome to today's webinar. I'm Rick Bone, partner and director of business development at Blueprint Investment Partners. And thanks for being here today. And as you know, we're going to be talking about ESG investing and how you can use it to differentiate your practice. Before we get there, I want to share two housekeeping items with you. The first is we are recording, so you can expect a replay in your email later today or tomorrow. And second, if you have any questions throughout the webinar, please type them into the chat box. We'll cover as many questions as we can at the end, and we'll follow up by email if there are any that we aren't able to get to during the call. With that, I hand things off to John Robinson, who is our co-founder and CEO of Blueprint Investment Partners.
Thanks, Rick. Thanks for that introduction. Good morning, everyone. I just want to reiterate, how appreciative we are of your time and that you're spending some of that with us this morning, particularly in such a wild and season that we're in right now with the coronavirus. As we're moving closer to the holidays, time becomes more scarce. And so we really value and appreciate yours. So before we get started, I just wanted to kind of set the table for what we're going to cover today. So first, we're really going to talk about the ESG market as a whole and look at the assets and asset flows and geographical disparities between the US and Europe and how sustainable assets have grown and where they are today. Then we're going to move into, okay, how does Blueprint fit into this market and what is Blueprint offering in terms of an ESG strategy and specifically our US ESG Select strategy. And then we're going to talk about what that strategy is, how it makes asset allocation decisions, what are the techniques and tools and risk management components underneath the strategy that drive allocations. And then we're going to go over Q&A and how you can access the strategy. So let's get started. As you can see on this slide, demand for sustainable funds, which is prior to about 2012, ESG was known as SRI or sustainable investing. So when you look at this since 2000, sustainable fund assets in the US have grown at a compound annual growth rate of 42%. And they currently sit at 55 billion. And this is across the board. This data comes from Morningstar. Now that looks impressive. I can't find anything that's compounded at 42% since 2000. So for assets to have grown at this clip to $55 billion in the US, it's impressive. And I don't think 10 years ago that anyone could have foreseen this kind of growth in sustainable fund assets. Now, with that said, it's always valuable to look at things on an absolute basis and a relative basis. So this is the absolute growth in the US. And this is the relative growth of the US compared to the rest of the world. So while the US is right now at 55 billion in sustainable fund assets, Europe is approximately 650 billion ahead of the US. And so to put that in different terms, if the US continues growing at the compound rate it has since 2000 of about 42%, it's still going to take 7 years for the US to match Europe in terms of total assets under management. So when you zoom out and you think about the macro environment, what is ESG globally? The US is really an emerging market, which for us as a money manager is very exciting because it gives us an opportunity to see, the potential for this market. If we design innovative strategies that blend both an investor's values and investor's goals, we feel like there is a massive opportunity. But this is about you today, right? The advisor. And so for you, if you're not getting questions about ESG yet, you will. And at some point with government mandates, statewide mandates, local mandates, institutional mandates, like we've seen from BlackRock and other pensions, CalPERS, the demand for ESG is going to grow. So I just want to applaud you and acknowledge that by being on this webinar and learning a little bit more about ESG perhaps, or furthering that knowledge, you're going to do nothing but better serve yourself via your practice and your clients. So for Blueprint, we look at ESG investing as the current set of available options are insufficient to meet both clients' long-term objectives and marry with that the risk management component that we feel is so important to preserve compounding and help clients meet their goals. So we don't believe that it's true that clients should have to choose between, hey, I have this thing over here that screens out certain characteristics of companies that I don't like or that don't align with my values. But I also know that it's passive and it's equity long only, and it could go down 50 to 60% at any one time. And I'm a retiree, and that really doesn't match what I'm trying to do, and it doesn't match my goals, and it certainly doesn't help me in my withdrawal rate each year. So I run the risk of catastrophic loss on the one hand, but I can really feel good about the values on the other. We think that is a failed premise. We don't accept that premise, and we feel like we combine the two with the risk management component of what we do in our strategy, as well as the selection criteria and the indexes we use to derive the portfolio. We feel like we blend those two things together in a systematic, disciplined risk management process. So here's a little bit about Blueprint and how we've taken our experience and what it is that we do well and map that over to ESG. So Blueprint's mission is to help advisors grow and strengthen their business through investment and practice management services. And we do that through the lens of a philosophical underpinning or a philosophical bent that's based on 4 pillars. And the first is that price is king. What we mean by that is that the most useful variable for us to look at, capture, manage, and execute on is the price of the asset class in question. So whether you're talking about an individual stock, whether you're talking about an index, whether you're talking about a precious metal, whatever that thing is, the closing price contains the most information as far as we're concerned. So we use that as the chief input in how we manage risk and how our systems make asset allocation decisions over time. Secondly, we believe that outlier returns are asymmetrical. This isn't necessarily our belief. This is just us acknowledging what the data says. And there's 2 parts to this. There's the mathematical part, which says after a certain magnitude of loss, the amount needed to recover begins to work against you exponentially. So for example, when you have a 50% loss, you need 100% to recover. And that loss, as you go from 50 to 60 to 70, doesn't just increase by 10% linearly, it increases by 50, 100, or 200% needed to recover. But then there's the behavioral part, right? The behavioral part is also asymmetrical because prospect theory tells us that the joy that the pain of losing is 2 times greater than the joy of winning. And so this is why we're about preserving capital. Ultimately, along those lines, systematic investing, which is what we do, which is to say that we design a set of rules that react to what is happening in the market or amongst the stocks in our portfolio. We design these rules ahead of time so that we're not emotional during emotionally charged environments, which are the environments which you are most likely to abandon a good plan. And so it doesn't remove the emotion from us, but it removes the emotion from the decision-making process. And that's the point. And lastly here, outsourcing investment management, according to the data and our experience, really empowers elite advisors to focus and hone in on those high impact activities. And what are those activities? Well, for elite advisors, those activities are practice management related, they're client management related, and they're business development related. Right? And we've written about this in the Elite Advisor Playbook. The last of those 4 pillars of what it means to be an elite advisor is the investment management piece. And elite advisors realize they can't do it all. So oftentimes, at least for the advisors we work with, we are the outsourced partner for elite advisors so that they can have that time back to do what it is that either they're best at or have the most leverage in. So let's talk about now how all of that sort of rolls up into our US ESG Select strategy. And again, we really believe so strongly that it is important, it's imperative to combine or marry clients' values and investing goals. And that is a powerful combination, not only mathematically, but also behaviorally, because we feel like if a client is invested in something that they have alignment in terms of values, that makes them just inherently more likely to stick with that investment during challenging times. And it's that ability to persevere that oftentimes the inability to persevere in those environments is the root cause of clients, in most cases, not achieving their goals. So what does the ESG Select strategy look like? Well, first and foremost, at the very top, it applies tactical management to the individual stocks of the MSCI USA ESG Select Index. Okay, so this is the top of the funnel. We've sort of created this graphic here, which gives a good illustration of the filtering process that we use to get down to the investable universe that could potentially make it into our portfolio. So first we start with the index, and then we optimize for investability. And what that means is that there are certain practical elements to managing accounts where account minimums come into play, where costs come into play. So, and turnover. So what we do to optimize for investability is we have mathematically demonstrated to ourselves that in an index that has 300 components, if the bottom 100 in terms of market cap weighting are about 0.4% and below, so their attribution to the index is extremely small. And we feel like that we can offer our strategy to a broader set of investors by reducing the number of holdings without losing any sort of prudency or risk management. So what we do is we take this basket of stocks and then we reduce any stock, we eliminate any stock from the investable universe that has a weighting of 0.4% or below. And this leaves us with about 125 stocks. And these stocks are typically large and mid-cap in nature. And so at the bottom of this funnel, this filtering process, comes the potential investable universe for our strategy. And so how the weightings of each stock happen is we don't argue with the index. It's our goal to outperform the index through our risk management components, but we don't argue about how each stock should be weighted at its baseline or at its standing start. So we take the index weight, and each stock's initial weight matches what it is inside the index. And then we adjust these allocations with risk management as the primary objective. And we do that using two types of diversification: time diversification and asset diversification, or a strategic component. Okay, so as we do that, we build a sector diversified portfolio that is comprised of large and mid-cap stocks with about 50 to 75 holdings approximately on average. That can go down in a bear market, and that can go up if we're having a broad-based rally across both mid and large cap stocks. And the asset allocation or rebalancing is risk-based, and it happens monthly using a systematic rules-based trend following approach that, again, allows us to protect against catastrophic loss and at the same time resist and hopefully circumvent and or avoid behavioral bias. And then the trend following is implemented with two speeds or two time frames: the intermediate term time frame and the long-term time frame. So basically what this does is it gives us not only diversification across 75 holdings, but then we split the allocation up amongst those holdings into two parts. One that's going to manage risk over at a faster pace using the intermediate term trend, and one that's going to manage risk and allocation decisions at a slower pace using the long-term trend. So how this strategy differs from the index, I mean, we're using the index to create the ocean for us in which to fish out of, or the pond in which to fish out of. But the fact is that the index is inherently passive. Yes, it has some component changes to it, and it might reweight these components on a semi-annual or annual basis, but it doesn't dynamically reallocate on any other basis. But the blueprint strategy does, and we feel like this is our edge, not only the behavioral edge of being systematic, but how we dynamically reallocate amongst the stocks that are comprised in the index. And so at the highest level, we overweight better performing stocks because they are maintaining their trend over both timeframes, and we're underweighting and in some cases eliminating exposure to the worst performers in the index, because inherently in most cases you can't become a poor performing stock without creating a downtrend in order to get there. And so it's the identification of our rules and strategies of that trend. And then every month we look at what the trend is per stock, per time frame, and reduce exposure to it. So that's really the first component here. If you consider this a 4-part process, we apply trend following to dynamically adjust the allocations monthly, with the goal being preserving capital by reducing exposure to those poor performers, and then taking the proceeds from the sale of those poor performers and reallocating it back or redeploying it back to those stocks that remain in a rising trend state, with the goal of providing a smoother ride for the investor, giving them staying power, not only avoiding the catastrophic loss, but the attempt of keeping expected return at or near its highest point, but also just the smoother ride of avoiding the emotionally charged environments and giving them the ability to sit through in all environments, not just one, which is the case with most passive investments. So in doing that, in reducing exposure to these poor performers and then redeploying or reallocating back to the better performers, you get an opportunity to see how trend following allows you to preserve capital. And so we wanted to take a real-time example of some portfolio holdings just to demonstrate to you how this works. So on the screen here in this table, you see this is the 10 worst performing stocks in the Blueprint ESG strategy portfolio against the index weight. So we're looking at the Blueprint weight and the index weight. So let's just back up a second. First of all, the average performance of the bottom 10 holdings in the portfolio is negative 44% year to date through September. Now this comes when the index is up about 10%. The S&P is up about 5%. Most equity indices are hovering around zero. Plus 10, minus 10 is probably where the majority of the indices sit now, with the exception of tech on the upside and dividend stocks and value on the downside, which are having a pretty tough year. So what this demonstrates to us and shows us is that the distribution of returns for this index is just like every other index, where you have a sampling of really bad performers, a small sampling of really good performers, and then all other stocks cluster around the average or the median. So when you look at how the trend following component has shifted the exposure away from the bottom 10 stocks, look no further than the column that says Blueprint average allocation, right, which has had a 0.51% exposure, aggregate exposure, to the bottom 10 stocks this year. That's not because of any predicted value by Blueprint, but what it has to do with is the fact that because the trend, in many cases, the trend was down coming into 2020, so we actually haven't held many of these stocks all year. So another way to put that is the downtrends can be so persistent that by just looking at the trend, paying attention to it, identifying and reacting to it, you preserve capital and you stay out of, you run a higher probability of staying out of trouble, right? So compare that column to the index weight, which has had just over 3% exposure to each of these stocks. So by doing something as opposed to doing nothing, we were able to avoid a huge majority of the downfall that these stocks have generated this year simply by reallocating away from them on the basis of trend. And so, we believe that trend following, it's been our experience that trend following can improve performance by reducing exposure to the worst performers.
Hey, John, sorry to interrupt you, but this slide comes up quite a bit when I'm talking to advisors and them wanting to know what is it that we do within the strategy to help reduce the exposure to certain stocks to get to that 50 to 75 names, whereas the index can hold as many as 150 or more.
Yeah, I mean, that's a good question. Thanks for stopping me. I mean, there's really two reasons that we hold both fewer stocks and less allocation to the poor performers. First of all, the investability screen that I talked about earlier is a way that we cut down, from 300 to, so let's say 150, right? And then how do we get from 150 to 50 to 75 holdings is using the risk management component of trend following to determine whether or not each of these stocks should have an allocation. That's one way. And, a lot of times I learn and borrow stuff from conversations that we have along the way. And an advisor recently said to us, he said, in a passive index, all the stocks get chosen and their place in the index is fixed. With what you guys are doing, you're really requiring each of those stocks to earn its way into the portfolio, and then it has to stay there on the basis of its own merit. So no stock is safe in our portfolio. It continually, day after day, has to earn its way in and then earn its way to stay. So by and large, trend following is the largest driver of how we get to this basket, this investable basket that we use. And in the end, that's going to be about roughly, in terms of exposure, about 90% of the index. So, what we do once we either eliminate a stock from contention or sell or reduce a stock that is now in a downtrend is we take that exposure and then we redeploy it pro rata back over the stocks that are continuing to be in a rising trend. And I'm sure many people listening to this now are asking themselves the question, well, how far can you go? Could the portfolio look like two stocks at a 50% weighting? No, good question. Assuming somebody's asking it. There is a max exposure for each of the stocks, and I'll get into that in just a few minutes. But Rick, does that answer your question?
Yep, I have myself on mute there, but yes, it does. That's perfect, because the question does come up a lot, and it's always nice to hear the reason we do what we do.
Yeah. Thanks for stopping me on that. That was a good one. So the previous slide looked at the portfolio, the investable universe based on the screens that Blueprint employs in order to get to this investable universe. And so what we wanted to do now is broaden that out and apply it to the entire index. And just to give proof of concept, if nothing else, but also test this idea that you by using trend following, you reduce exposure to the worst performers and then increase slightly but materially the allocation to the best performers. And so you can see here two tables. On the left, you have the best 10 performing stocks through September in the index. And on the right, you have the bottom 10 performing stocks in the index through September. And by and large, you can see that Blueprint's increased allocations to the top performing stocks and reduced exposure to the poor performers. And this is because of our trend following discipline. I mean, you can see on the left here, you've got, Apple, Microsoft, Salesforce, Google, et cetera. They're on average up 35% through September. And if you look at the weighting, the average weighting to those is about 2.8% with about 28% aggregate exposure. Now, on the other side, the bottom 10 performing stocks through September, they're on average down 26%, with the Blueprint allocation at almost zero, 8 basis points. And this on a percentage basis, the percentage change basis is significantly more than the index itself. And so just on the extremes of the distribution of the tails, the positive tail, the negative tail, we've been able to accomplish our goal, which is to systematically employ trend following over these stocks to push ever so slightly the exposure towards the best performers and reduce the impact of the worst performers over time. And look, in some years you're going to get the distribution is going to be more narrow, and we're going to reduce exposure less to the poor performers because there will be fewer of them that are in downtrends, like 2017 or 2019. But in a year like 2018 or even 2020, the disparity between the extremes, the better performers and the worst performers, is huge. And 2020 happens to be among the widest in terms of the difference between the better performers and the worst performers. And so this year is a great example of the power of the process in using trend following in order to dictate asset allocation decisions. So when you think about it, the strategy being sector diversified, we're sector diversified because of the number of holdings that we have across sectors, but also by using trend following for asset allocation purposes, we feel like we better optimize the exposure to those sectors relative to the index. And you can see how our strategy adjusts on a month-to-month basis. So for example, the darker colored bars here are the September 2020 allocation and the allocations, and the turquoise bar is the October 20 allocation. So the delta is what we bought or sold amongst the stocks comprised in each of these sectors month over month. And you can see here, where your eye is probably going is technology, right? Where we reduced exposure going into October because we started to get some intermediate term downtrends in some of the larger tech names. Now, where my eye goes is the energy sector to the far left, which is we have had zero exposure to energy. Not because we knew oil was going to go down 60% in a year, not that we knew Exxon or any of the oil companies were going to have a borderline collapse this year, because we've held almost zero exposure to this sector for the entire year, because in 2019 their downtrends manifested themselves. So we actually reduced exposure to many of the energy stocks in the third quarter of 2019. So it's now been over a year since we've had any energy exposure on. And I think that illustrates a very important point, that we don't believe prediction is repeatable, number one, but you don't have to employ prediction and lock yourself into something, even if the world, we call it arguing with the market. You don't have to argue with the market, because for us, we're taking our cues from the market. And that allows us to have this amoebic, dynamic process in order to better optimize exposure. And again, it goes back to the sector and the stock have to earn their way into the index by performing well. And if they don't, they will either be contained in a blueprint strategy with less exposure, or no exposure until they've proven themselves otherwise. So I want to just take a second and go over the asset allocation process. So on the screen, you have in a fictitious example, ABC company stock. And really the stock can do one of two things. It can go up and generate a rising trend, or it can go down and generate a falling trend. Now, the stock can stay flat, but it's still going to generate a trend. So these are the two states of the world for ABC company stock. So let's take the uptrend example. So let's say in ABC company stock, you have an uptrend over both timeframes, the intermediate and the long term. And therefore, the stock has its baseline exposure. From there, you can increase the weighting to the baseline exposure to 1.2 times the index, or 120% of the index weighting. So this is the max I talked about earlier, where we want to push exposure higher than the index if the stock is in a rising trend, but only to a point, because we want to be prudent in our diversification. We want to limit our overexposure to any one stock, and we want to prevent any one stock from driving or attributing so much to the portfolio that really we end up holding one stock, or at least the performance of the strategy is dependent on one stock. Risk management is about reducing dependencies, not increasing dependencies. And so for us, this is how we increase the weight from the baseline to an overweight stance. So let's take the opposite case of a downtrend. In order for us to decrease weighting to a stock, which can decrease to zero, the stock in question has to be in a downtrend over one of the time frames. So if it's in a downtrend over the intermediate term and not the long term, we reduce its exposure by half. If it's in a downtrend over both time frames, we can reduce exposure to zero and do one of two things with the proceeds. Redeploy back to rising trend stocks up to 120% of their weighting. And if all the stocks remaining are at their maximum allocation, then we hand it off to an ESG bond ETF for capital preservation purposes until the rising trends resume in the stocks that we've recently sold. And what this does is this happens every month, and we feel like it gives us a repeatable process to both be opportunistic, take advantage of rising stocks, particularly the stocks that are the strongest in the index, but equal parts protecting against the downside and preserving capital. So this is really where this blend of values, which the client or the investor would be aligned with as an ESG investor, because we're taking one of the most widely known, scrutinized ESG indexes in the world. And we've resigned ourselves to only using holdings that are comprised in the index. That's the values piece. But on the quantitative piece, the goals piece, this screen here, this slide really demonstrates how we preserve that capital and why the process is repeatable. So when we talk about next steps, you might be thinking as an investor, well, where is the Blueprint USG ESG Select strategy available? Well, it's available at most major custodians and TAMs. That's Envestnet, that's Schwab, that's Fidelity, that's TD, and others. I don't think you'll have trouble finding it, and please ask us if you want a more precise answer to that question given your specific situation. I would also encourage you to sign up for our monthly portfolio updates and our insights and blogs. We typically write about behavioral finance, systematic investing, and practice management. And on the screen here, blueprintip.com/subscribe will get you to the place where you can curate exactly what it is that you want to see from us. We would love to talk to you. not just about the ESG strategy, but any strategy we have, but particularly about the ESG strategy. If you have questions, please reach out to us and set up some time at letstalk@blueprintip.com. And then to learn more, do a deeper dive, a more granular look at the ESG strategy itself, you can go to blueprintip.com/ESG. So with that, I want to turn to you, Rick, and just ask if there's any questions that have come in as I've been talking, and maybe pick, 3. And if we can't get to the other ones because of time, then we can just,
Sure.
answer those in an email and send them out.
Yep, no, that'd be great. We did get, we got 3 right off the bat. The first one comes up a lot is, where can the advisor recommend using the Blueprint ESG strategy in a portfolio?
That's a good question. We get a lot of use case questions because our strategies are nimble and adaptable and can be used in a lot of different ways. I think the best way to answer that question is to say what we see advisors doing with the strategy now. And what we see them doing with the strategy now is one of 2 things. They'll use the ESG Select strategy as a total portfolio for more aggressive clients or for more equity-based clients. And on the other hand, they may use it as the core equity piece in an otherwise diversified portfolio and pair satellite holdings with it, whether they're ESG satellite holdings or not. They'll use our ESG stock strategy as the cornerstone piece of a portfolio. So it's either the equity only piece or it's the equity component inside an otherwise diversified strategy.
Since it's a large mid-cap core allocation, I would assume that could be part of the model for their clients as well.
Yeah, exactly. Okay. And if they, an advisor wants to cut up the portfolio and drill deeper into the sub-asset classes or by market cap or by factor, they can do that too and use our strategy as the large cap, mid cap piece of that.
Okay. And then another one that comes up quite a bit is with our sell discipline and the way we do it, does it make it tax efficient?
Yeah, that's a good question. The way we typically describe that is we wouldn't say that our strategy is geared for tax efficiency all the time. But what we would say is our experience has been, and the data says that our strategies are at worst tax neutral. And how that comes about is, number one, we do explicit tax loss harvesting because this is an equity strategy, and it's it's not difficult for us to do, but it can be very impactful, and so we do it. But also the maybe implicit or inherent nature of the strategy relative to taxes is the nature of trend following is that it lets winners ride and it cuts losses short. And by doing that, we are consistently on a monthly basis, not every month, but on a monthly basis, we may sell a stock and harvest a loss. Now we're harvesting gains too, but by and large, we're harvesting short-term losses by looking at the portfolio on a monthly basis and selling those things that have moved against us by a certain amount and holding those things that have moved with us. And on that side, the gain side, about 75% of the gains in this strategy, really across the board at Blueprint, turn into long-term gains. So, the tax neutrality of the strategy is something I feel very comfortable saying and standing behind. And in many cases, it is tax efficient.
I know one of the big parts of what Blueprint does is we're big into research. And how long did you research the ESG space before jumping into it? And how long have you been managing ESG?
Yeah, it is interesting. If you go back to the beginning of the presentation and look at the market size, there are a lot of firms jumping into this now, and there's nothing wrong with that. Whether or not they believe in and the factors of the E, the S, and the G, and hold those things dear and value those things is, not my call. But we first started working on socially responsible investing back in 2011. And we partnered with a much larger firm in order to design them a systematic strategy to run inside of a fund. And so that really got us down the path of looking at these factors as SRI has now evolved to ESG, and breaking down the factors, doing research around the factors to see, is this just a values thing, or is this also an investing thing, and can you bring them together? And in our estimation, it's both, and we brought them together in this strategy. So, we've been looking at this and researching this and building systems and strategies around these factors for, close to 10 years now.
Great. Well, that will wrap it for the questions, John. Thanks for your time today, and thanks for everybody else for coming in and joining the webinar. And as we said, we'll be sending out an email later today or tomorrow with a replay of the whole presentation. Thanks for your time.
Thank you.